So I'll just give it a second or two. Should I go ahead?
I think not yet, David.
Okay, I think I'm just going to go ahead and get started. That's okay with everybody. Okay, so this paper is optimal design of funding for lending programs. It's co-authored with David Rappoport. We're both at the Fed board. So, in terms of an introduction, funding for lending programs. Essentially a funding for lending program is a program where banks are offered cheap funding from the central bank, and the objective of the program is to stimulate bank lending. In response to both the Great Recession as well as the COVID-19 global pandemics, several central banks around the world implemented funding for lending programs. These new implementation of funding for lending programs are so-called modern funding for lending programs in the sense that they have certain design features that are intended to enhance their effectiveness. So the purpose of this paper is to take a look at some of these new design features in funding for lending programs and try to understand how these mechanisms help amplify the marginal lending incentive of banks. And once we understand that, to help us think about if we wanted to implement a funding for lending program, given, the heterogeneity that we see in the banking system, how can we design a program that maximizes the lending response? That's really the point of this paper. So before I get into the details, let me start with a little bit of institutional background. First and foremost, funding for lending programs aren't new. In fact, in the Federal Reserve, the Fed implemented what's called the seasonal credit facility back in the early 1970s. And the purpose of that facility is to provide agricultural banks with reliable access to market funds, when they face seasonal variation in loan demand in the agricultural sector. So, the Fed is familiar with funding for lending programs. And moreover, as I said on the previous slide, a bunch of central banks have implemented programs of this nature, both after the Great Recession and in response to COVID-19. So two prominent examples are the Bank of England's term funding for small and medium enterprises and the ECB's TLTRO. There are some other central banks that have implemented programs as well. The BOJ, the Royal Bank of Australia, and the Swiss National Bank all have versions of funding for lending programs. One thing I wanted to say is that particularly in the case of the BOE and the ECB, these programs can be quite large. The borrowing allowances are in the neighborhood of 10% of GDP, which, if you put this in the U.S. context, that's about the size of the Fed's Main Street lending program. So these are large programs. So again, in this paper, what we want to do is focus on some key design features of these modern funding for lending programs implemented, for example, by the BOE and the ECB. And in particular, the features we're interested in is, one feature where funding, part of the program design is that funding gets cheaper as lending increases over a predefined range. So this is a so-called Z-curve design. The idea is that, as you increase lending, you're able to, over a certain predefined range, you're able to access cheaper and cheaper funding. So there's a large incentive to boost your funding to access cheaper funding through the program. And the other feature is that these programs offer more than $1 in funding for every additional dollar of lending that the bank agrees to undertake. So the purpose of this paper is to investigate these two mechanisms and try to understand how they boost the marginal lending incentive of banks. In a nutshell, the main takeaway of this paper is that we're going to argue that a modern funding for lending program is capable of generating amplified lending responses that we're going to argue can be as potent as traditional monetary policy in promoting bank lending. So that's going to be the main takeaway of the paper. The way we're going to make this argument is we're going to present a simple framework of funding costs and optimal bank lending. We're going to use that simple framework to introduce funding for lending programs of increasing severity or increasing complexity. We're going to use the framework in the program design to derive some measurement equations that are going to be very easy to take to the data. And I'll show you how we do this. And we're going to take those measurement equations to US data. Given the distribution of the US banking system, we're going to analyze how different funding for lending programs, different features influence bank lending. So that's the paper. So let me just jump right into a simple framework, describe our theoretical framework. Basically, the idea here is to describe how an individual bank makes a loan supply decision, taking as given the demand for loans and the cost of its financing costs. So the framework is simple. It's static. It considers a bunch of islands. Each island is going to be inhibited by a large number of identical banks. What banks do is they supply loans, they demand funding, and they use that funding to supply loans to firms. Firms, exist on the island as well. The firms that demand loans from banks, loan demand is homogeneous across islands, and it's summarized by an isoelastic inverse demand function. So those are islands. Islands are populated by banks and firms. So there are two agents in the model that operate across all islands. One is a central bank. For now, a central bank is just going to implement monetary policy, which I'll describe in a minute. Later in the talk, we're going to introduce a central bank that also implements a funding for lending program. The other agent that operates across islands are investors. Investors supply wholesale funds to banks. Investors are deep-pocketed. They're patient. They can invest in government securities, which are denoted RS, or they can lend wholesale funds to banks who pay the cost rho. So in the model, the supply of wholesale funds is fully elastic, and it's given at the rate at the bottom, the equation at the bottom of the slide, RF, which is just the sum of the rate on securities plus the cost of wholesale funding. So that's the structure of the model. Talked a little bit about the central bank. For now, the central bank is just going to implement monetary policy using a quarter system. So basically what the central bank does is it funds itself with reserves and it offers funding through the discount window. The quarter for monetary policy is going to be the distance between the discount window rate, which defines the upper bound of the quarter, and the rate on government securities, which is going to be the lower bound. So in this simple model, government securities just represent reserves or short-term treasuries. So that's the central bank and that's monetary policy. As I said, in a minute, we're going to introduce a funding for lending program into the central bank as well, but hold on to that for a minute. Instead, we'll turn to banks. So consider one bank I on an island. A bank's balance sheet is described by assets, which are going to be loans that it issues and government security it holds. Those assets are going to be funded by equity, wholesale funding, deposit window advances, discount window advances and deposits on the liability side. So that's the bank's balance sheet. And then we're also going to assume that there's a non-interest expense function that is increasing, convex, and isoelastic. So the idea here is that in order to write a loan, the bank has to pay some non-interest expense, associated with processing that loan. And the important parameter to keep in mind on the non-interest expense function is that the epsilon parameter is going to allow us to pin down the loan supply elasticity with respect to the interest rate. So that's going to be an important parameter that I'll describe in a minute. So that's a description of the bank. The bank's problem is to basically to maximize profits. It's going to choose loan supply in the structure of its balance sheet, with the objective of maximizing its profits. So to keep the problem tractable, we're going to make some simplifying assumptions. We're going to assume that equity, deposits, and securities are all pre-existing. So that means that the bank's optimal decision is going to boil down to adjusting loans on the asset side and its funding through wholesale funding and discount window funding. So this is a simplifying assumption that just boils down the bank's optimization problem to something that's very simple to deal with. And at the end of the day, when banks maximize profit, the equation at the bottom is going to be an inverse loan supply condition, which equates the marginal net interest income to the marginal non-interest cost of issuing a loan. So that's going to be the optimal loan supply condition is the equation at the bottom of the slide. Embedded to the right-hand side in the marginal non-interest cost is the loan supply elasticity parameter, which in turn is governed by the parameter I discussed on the previous slide. So that's the bank's problem, and that's its optimal loan supply behavior. What we want to do now is that simple model that describes a simple bank, profit maximizing bank, and how it supplies loans to firms. What we want to do now is introduce a funding for lending program into the model. So on this slide, I'm going to discuss a general funding for lending program, and then in a couple slides that follow, I'm going to be very specific about particular types of funding for lending programs that we consider in the paper. So. So in a funding for lending program, basically what's going to happen is the central bank is going to extend some low cost funding that we're going to denote F hat to a bank I, and it's going to extend that funding at a rate R hat. So at the end of the day, when we describe a funding for lending program, it's going to consist of a pair, and the pair is going to describe the maximum amount of available funding across all banks, and that's going to be F upper bar, as well as the funding costs for that funding, and that's going to be R hat. So that pair describes the funding for lending program, and in a key design feature that we're going to examine in the paper is versions of funding for lending programs that allow the maximum amount of available funding to depend on banks' lending decisions, as well as the amount, the cost that the actual bank pays to also depend on the bank's lending decision. And the simple intuition here is that by tying these two things together, basically you're allowing the bank to internalize its decision on optimal loan supply. Has an influence on both the quantity of funding that's available to it, as well as the cost of that funding. And by allowing the bank to internalize that link, these features are going to be able to, we'll show in the paper, are going to be able to generate very strong lending incentives that are going to be the focus of the paper. Okay. So the last thing I want to discuss is the size of the program. And this bullet point at the bottom essentially is going to basically, this is in a nutshell what this bullet point tells you is we're going to allow for a conservative assumption that the funding for lending program is going to lower cost of funds relative to the outside option of the bank going to the discount window, absent stigma. Okay, so in a nutshell, what this last bullet point says is that any bank that pays a sufficiently high market cost for wholesale funding could always opt just to go to the discount window in absence of stigma. But alternatively, if the program is sufficiently generous, the bank would prefer to borrow from the program simply because it's a better deal. So in a nutshell, this assumption is in the model simply because it allows the possibility for the bank, if it has a better outside option of going to the discount window absent stigma, we want to allow the bank the possibility to take advantage of that outside option. So what I can tell you is that in practice, when we take this to the data, this assumption is not really all that important. In fact, most banks prefer to borrow from the funding for lending program at the maximum size of the program allowance. Okay, so with that background, what we're going to do now in the paper is to introduce 3 specific program designs, each of increasing severity. Okay, and I think I've got to speed up here a little bit. The first is a simple funding for lending program. Basically, it offers a subsidy with unlimited funding. So this is just a pure subsidy. The pure subsidy works exactly as you would expect. It drives a wedge into the optimal loan supply. When we look at the bank's optimal lending behavior, what we can do is derive a very simple analytical expression at the bottom of the slide that tells us how banks would adjust their lending behavior in response to this simple funding for lending program. The response in lending has 2 components. There's an equilibrium adjustment that's governed by the loan supply and loan demand function. That's the term on the left. There's also the direct effect of the subsidy itself. So we can decompose the bank's lending response into these two channels: an equilibrium adjustment and a direct adjustment. So to sort of focus ideas, the program's simple enough that you could just put this on a simple supply and demand graph, and what you could see is the impact of the subsidy itself is associated with the downward arrow labeled number 1. That's an expansion of the loan supply conditional on the subsidy. And then you have an equilibrium adjustment, which is the 45-degree arrow mark 2 on the slide. The total adjustment is the equation at the bottom. The bottom line is this is just a simple subsidy. It works exactly as you would think a simple subsidy works. So then we move to some more complex program designs. So one program, one sort of incremental increase in complexity of the program is to introduce a multiplier effect, where we're going to let the amount of funding, be capped as a multiple on the quantity of loans that the bank offers. So with this simple or with this minor, increase in complexity of the program, what that does is it brings into play bank heterogeneity. So when we think about how this impacts the marginal lending incentive, what happens is, the banking system can be divided into 2 parts of the parameter space. In one part of the parameter space, you might have banks that are not reliant, particularly reliant on wholesale funding. And in that case, the column on the left shows you that, for these banks, this is going to the funding for lending program is going to act like a simple subsidy that I just showed you. And the results are identical for these banks. On the other hand, you're going to have a subset of banks that are really heavily dependent on wholesale funding. And for those banks, they understand that accessing this program is very valuable to them, and there's going to be an amplified effect. And you can see that in the second row under the direct lending. If you compare the left column to the right, that mu shows up. And that mu is basically the amplification mechanism that comes from this multiplier lever. So the last thing we're going to do is we're going to introduce a sliding scale incentive into the program. And in a nutshell, what the sliding scale incentive does is it says that, for a given bank, imagine that your lending is such that you're to the left of some threshold. What the sliding scale incentive says is that if your lending is sufficiently low, that you're below the threshold, you're actually not going to have access to the subsidized rate through the program at all. But if you increase your lending, above L lower bar, what the program is going to do is offer you discounted funds at an increasingly favorable rate until you hit some upper bound at which the full subsidy is going to kick in. So, as banks increase their lending, they sort of understand that they're accessing cheaper and cheaper funding. So there should be a strong incentive for a bank to boost lending to access that cheaper funding. So this sliding scale incentive, it increases the complexity of the program. What this matrix right here does is it splits the parameter space in the model and shows you how the marginal lending space, the marginal lending incentive varies over the parameter space. The parameter space is divided up for a given bank where you fit on the sliding scale and whether or not the funding constraint is binding. So you can divide the parameter space into unique parts, and the model is sufficiently tractable that we can analytically come up with expressions for the marginal lending incentive in each of these parameter spaces. In a nutshell, the incentive is going to be strongest if you're on the sliding scale and the funding constraint is binding. We can show analytically that that is going to generate the strongest lending incentive. So let me go through calibration really quickly because timing is kind of getting short. With regard to calibration, we take these analytic expressions to the data. We calibrate the model using loan supply and demand elasticities that we take from the literature. We then go to the US banking data to get the distribution of data for all banks in the US banking system on their reliance on wholesale funding, which is the top panel, as well as the cost of that funding, which is in the bottom panel. And we get for the average bank, we get for the entire distribution of banks. We can use that information then for each bank in the US banking system to figure out what their funding discount would be, conditional on where they might fall on a sliding scale that we implement. And then finally, to take these analytic expressions to the data, we have to specify the program parameters. We use a multiplier of 2, and we use a Z-curve design that kicks in once you hit 5% deleveraging on your balance sheet, and it kicks in at an increasing rate up until a 5% expansion. If you expand your balance sheet beyond 5%, you get the full benefit of the subsidy. So that's our Z-curve, and that's the multiplier. And then for the empirical implementation, we look at C&I loan growth for every bank over the period 2019 Q3 to 2020 Q3. And then we assume that our funding for lending program, hypothetical funding for lending program, is announced in Q2 of 2020. So where you fall on the sliding scale for each bank depends on what happens between 2020 Q2 and 2020 Q3. So the results I'll go through pretty quickly. For the simple program, we find that there's an increase in if you take this to the data and you get the distribution of lending impacts across all banks in the US banking system, the increase in C&I lending growth for the average US banks is about 5.5 basis points. That translates into roughly 1.1 billion in additional lending when you apply it to the 2 trillion in total C&I lending in the US data. The multiplier program boosts that impact to about 7.25 basis points. So that's about 1.5 billion in additional C&I lending. And that's about a 30% increase in effectiveness of the program. So the multiplier doesn't double the effectiveness of the program because not all banks face the binding funding constraint. You'll see, the 75th percentile of banks in the table on the far right, you can see that they have a much larger impact than banks that don't face the funding constraint. And when you average that out, it ends up being about 7.25%. So the next thing we do is analyze a sliding scale program. We do it without the multiplier. In the interest of time, I'm going to skip this and just goes to the sliding scale program with a multiplier. And here we find total C&I lending growth for the average U.S. bank for the average U.S. bank is about 25 basis points. And that's about a 5-fold increase over the simple program. So what we take from this is that, these enhanced program features for modern funding for lending programs really do a significant job of impacting the effectiveness of these programs. And I should note that for banks that fall, in the region of the parameter space where the impact is largest, the impact of these programs is really large. It's about, we find that for some banks in the US data, depending on where they fall, it can be as large as 120 basis points of additional C&I loan growth, which is a large impact. I'll wrap up quickly. It's useful to put the results in broader context. The blue bars in this graph show our simple funding for lending program, the multiplier with the Z-curve, the impact in terms of additional C&I lending in billions of dollars. The bar on the right is taken for Bernanke and Blinder, and that's their estimate from the 1992 paper of the impact of a 25 basis point monetary policy easing, the impact on bank lending. They find it increases by about 6.5 billion. And we note that a properly designed FFLP can generate results in that neighborhood. So I'm short on time. One additional thing I wanted to say is that what we learned from this paper is that the role of heterogeneity is really important. The more heterogeneous your banking system is, the more difficult it is to design an optimized funding for lending program. And the reason is that more heterogeneity in the banking system basically leads to wider dispersion of marginal lending incentives, which are created by the program. So, two things we think about are what would a program look like if hypothetically your banking system were homogeneous, and if you could tailor the program to have a maximal impact on that homogeneous bank. The answer is the impact of the program can be very large indeed. We're not fortunate enough to have a completely homogeneous banking system. Instead, in the U.S. it's quite heterogeneous. So another exercise we did was design an optimized funding for lending program that takes the heterogeneity as given. I'm not going to talk through these results, but our baseline calibration is in the neighborhood of an optimized funding for lending program. We find if we boost the multiplier above 2, we could probably get a little bit more kick out of it. So with that, I'm out of time, and let me just say that one reason we looked at U.S. data in this paper is because that was what was readily available to us. We think the paper or the framework is tractable and simple enough that you could easily apply this methodology to other jurisdictions that actually implemented FFLP programs. We didn't do that just because we didn't have the data readily available. So with that, I'll stop.
Thank you very much, David. Diana, would you please
sure.
start your discussion? Can you?
You have to stop sharing, David, please. Okay. Perfect.
Yes. So hopefully you can.
No, I can't do it.
Yeah. How do I stop sharing?
No, you did it, or at least it happened. No
Thank
problem.
you very much.
Thank you. Okay, so thank you for the invitation to discuss this really interesting paper. So the paper looks at just put it here. Okay. So I think David's presentation was really clear about what the paper tries to do. Right, there's one very clear research question, which is to try to understand how effective these funding for lending programs can be for monetary policy. And so David had to rush at the end of the presentation. So let me try now to kind of make even clearer what are the main takeaways, what are the main conclusions of the analysis. So the number one finding is really that, these programs can stimulate lending if they're adequately designed. And so this chart that David showed at the end with the different coefficients and the different designs of the program shows that, the outcome can really be different and the design matters. What the paper also shows is that there's this trade-off between what is the scope of the program and what is the marginal lending incentive for the banks to participate. Okay, and so here again, how specifically the program is designed is going to matter. And the final point that David was making, and I think it's really crucial for the results, is to show that the heterogeneity in the banking system matters, right? So the model starts, with these banks that are entirely atomistic and all the same, but in reality, how the banking system looks like and how heterogeneous it is, it's going to matter a lot for the effectiveness of these funding for lending programs. And so I believe that this paper really has a very important contribution to the literature, because there are some empirical papers out there looking into the effectiveness of these targeted monetary policy lending operations. Especially for the euro area, but also for the UK. But we don't really have, as far as I know, a good theoretical understanding of the mechanisms at work. And this is what David does in this paper. And so, the conclusions are really clear about how important these programs can be in the monetary policy toolkit, especially if we're in the low-rate environment. And so just yesterday, the ECB announced a new strategy. And one of the many things that is there is that, these unconventional tools are kind of to be seen as part of the regular toolkit, and targeted lending operations are possibly one of them. So I really liked reading the paper, and I really believe the contribution. I have a few questions where I think, more work could be interesting, or we could even learn more from what the authors are doing. So I have some questions about, taking a step back and thinking, what do these programs really want to achieve, and when do they want to do it, and how? So when we read a paper, it seems that, the funding for lending operations, their number one goal is to make sure that the banks are going to lend more. And that is fine. But it can be more subtle than that, right? And given that there's all this emphasis on the design of the program, this is important. Where exactly do you want this lending to happen? And for instance, in the euro area, the TLTRO operations, so the name we give to this funding for lending operations, for instance, they're specifically targeted at loans to firms and consumer loans, and they exclude mortgages. Okay, so this is something that can be debatable and can depend on what are the goals of the central bank. So it's interesting to think, to what extent do these kinds of operations that can be very targeted and can lead to different allocation of outcomes and resources in the economy, to what extent do they fit within the central bank mandate? Is this something that the central bank always wants to do, or is it some kind of special tool that only makes sense if pass-through is impaired? Okay, and so there's this general motivation in the paper that this is useful in a low-rate environment, but it would be incredibly useful to actually show what are the effects of these programs when there's regular pass-through of monetary policy, and so the central bank can just use the regular tools it has, versus the effectiveness when indeed the regular tools, there's a zero lower bound, and monetary policy cannot work as it's supposed to. And I think that would really show, what is special, and when is this type of program special. So a really interesting finding is to show that if these programs are adequately designed, they can be as potent as traditional monetary policy in promoting bank lending, right? So David showed this chart with the 4 bars, and it shows that in the last one, the effects are almost the same as that of traditional monetary policy. But then we should discuss, when should we use them? Okay, they do not seem to be as effective. And in a way, this is linked to the comment I was raising in the previous slide. The model makes much more sense if somehow the bank lending channel is not working properly. But if this is the case, if we see that the bank lending channel is not working as it's supposed to be, and there's some kind of disturbance in the pass-through of monetary policy, the implications of this incomplete pass-through can be very different if the channel is not working due to supply or due to demand constraints. Okay, and here again, the way we think about the program and what the program can achieve and deliver is going to depend on that. So for instance, if the problems come from banks' lack of willingness to grant credit, okay, this is typically where these funding for lending programs can make a difference, right? But at the same time, it's also debatable if this is the best tool possible to address supply constraints. So this is something that should be discussed. Also, the alternative hypothesis is that the bank lending channel or the pass-through is not working because there's actually not enough demand for credit. And here it's not so clear if the funding for lending is going to help or not. And so in this respect, I think it would be interesting to extend the model to look not only into lending volumes, but also into lending rates, which are kind of taken as given in the model. But in a way, when we look into the empirical literature on these funding for lending programs, typically people look into these two outcomes, right? We want to figure out if banks are lending more, but also if the lower rates are kind of being passed through to the customers. And this could be crucial if the origin of the problem is lack of demand for credit. Another broad comment that I have is about risk shifting, okay? And here it comes with a disclaimer that I'm currently working on something for the TLTROs linked with this risk shifting. And at least in the Portuguese data, this seems to be an issue. So the thing is, I mean, you're kind of encouraging the banks to borrow from the central bank at these really very good rates. And you want the banks to use this money to lend to the economy, and all the operations are designed in the way. So they're clearly superior to a similar operation that is totally untargeted. The thing is, I mean, there's still leeway, and you cannot totally rule out a possibility that the banks or some banks are going to use this cheap funding to still pile up on other securities, including on sovereign securities. Another possibility that can happen is even within the lending. Okay, you want more lending, but this might actually give some incentives for the banks to lend at any cost. And if they have to fulfill some targets, like they have to do in the euro area, they might feel under a strong pressure to lend to whoever comes to their door, or even to go to the door themselves and find new customers that are really very, very risky. I mean, I think bringing some, I mean, you have some ingredients of that in the model that I think you could better explore to allow us to learn a little bit better how this risk shifting and even risk taking can occur. Then I have, I mean, a few smaller points. I will be quicker on these ones for the sake of time. Let me just focus on those that are more important among the minor ones. So let me just say something about the third one, which is the policy in the paper is claimed to be able to be used as kind of, if you're in a low rate environment, but the central bank doesn't want to go into negative territory. Well, actually, I mean, this was what happened in the UK to some extent, but not really what happened in the euro area. So actually, the ECB did both almost at the same time. In 2014, rates became negative, and the TLTRO was implemented. So I think it would be interesting to figure out, I mean, what are the trade-offs? And this is something that indeed only we need a model to understand this, right? I mean, what are the different implications of going into negative policy rates versus using this funding for lending operations? Because I guess ultimately this is a policy advice that you want to offer with this paper. Another thing that I want.
Sorry, Diana, could we?
Okay,
could we skip it from here because we are already 5 minutes behind.
Okay. Just one.
I would suggest that you send your slides to David. It would be great, I guess, for David.
I will. Okay.
I would think that we start with Ellen's presentation. Sorry to interrupt you. Sorry, but I'm late.
No problem. These are smaller things, and I'll be happy to talk bilaterally with David.
Yeah, thank you very much for the great analysis. So please, Ellen, I hope you are here. Yes, Miss Ellen, please go ahead with your presentation.
I am here. Just give me 1 second and I'll put my slides up.
Yes, we can hear you.
Yes, great. Hold on, slides going up now. And you should be able to see my slides now.
Not yet, but
they're on their way.
Yeah, it's a black screen at the moment. So hopefully, yeah, now we see your slides. Thank you very much. And,
great.
Yes. Go ahead.
And they should be full screen now. So thanks very much. So I'm going to provide an overview of some work that I've been doing with my co-author, Karl Whelan. Before I start, I'd just like to give the usual disclaimer that I do work for the ECB, but the views in this paper and the analysis paper are those of myself and my co-author. They are not necessarily the views of the ECB or any associated authority. So my co-author and I have been doing some work for a few years now, looking at how the reserve expansion that happens as part of a QE program could maybe form part of the transmission of that program. So we think that, you know, this is part of QE that has been maybe under-examined by the literature so far. And that under-examination, to be honest, makes sense. We saw that, you know, following the introduction of QE programs around the world, following the global financial crisis, that money multipliers collapsed, which would suggest that banks maybe aren't using all these new reserves and trying to get rid of them and creating new loans and stimulating the economy that way, as, you know, a traditional money multiplier would suggest. And as a result, a lot of the literature on QE has either explicitly or implicitly assumed that banks just kind of ignore these reserves and allow them to passively build up, and that all the transmission happens via the purchases themselves. But while that has been the case so far, in recent years, there's actually been a developing number of sort of papers providing empirical evidence that banks do respond to this reserve expansion. One of them is actually by my co-author and I, and we presented it at CEBRA last year. So how do we match these two things? That on one hand, there's sort of empirical evidence that banks do respond to reserve creation by, buying assets or making loans, but money multipliers collapsed. So what we do in this paper is we develop a very simple micro-simulation model, and we simulate a banking system at the bank level, their response to a monetary expansion. From that simulation, we can produce our model monetary aggregate dynamics, and we can then compare them to observed monetary aggregate dynamics. And then by doing this, we can infer different bank behaviors from different monetary aggregate dynamics. And in particular, we can infer banks' demand for reserves. Very quickly as well, before I move on, I'd like to note that while this has an obvious impact on how we think about QE and how we think about the transmission of QE, understanding bank reserve demand is also really important for how we implement and think about conventional monetary policy. Very quickly, prior to the financial crisis, particularly in the US, banks existed in a reserve sort of deficit or in a scarce reserve environment. Conventional monetary policy was implemented by steering short-term money market rates, by changing the supply of reserves. The new framework is based on the assumption of an ample reserve environment, which also works, but you need to know when you are in an ample reserve environment and how many reserves you need for that. And we know then as balance sheets start to normalize that this can go wrong. And we saw that in September of 2019, where the banking system, even though it had way more reserves than were legally required of it under reserve requirements, started acting like it was in reserve deficit. So we think that understanding how banks deal with these reserves and respond to them, particularly their demand for the reserves, is actually a very important part of understanding the effect of QE policies. So we, in our model, which as I've said is really very simple, our model is based on the traditional money multiplier model, but we add 3 very simple features, and these features allow us to replicate US monetary aggregate dynamics between 2008 and 2019. The first change we make is that we allow banks their use of unwanted reserves to play out alongside QE purchases. And this change allows us to reproduce about 2/3 of that initial drop in the money multiplier that we saw with the introduction of QE. The next change we make is that we allow reserve demand to exceed the reserve requirement. And this produces the consistently lower money multipliers that we've seen. And we found our model suggests that banks appear to want to keep reserves equivalent to about 15 to 25% of deposits on their balance sheet. And the third change we make is that we introduce later on in our model capital requirements to banks. And this reduces their capacity to immediately use up reserves to create new loans or create new deposits. And this smooths out deposit creation. And as I said, with these 3 very simple features, we are actually able to replicate US monetary aggregate dynamics using the money multiplier model. And we do find that banks are actively, those monetary aggregate dynamics are actually consistent with banks actively using reserve balances, suggesting that this response to reserves might have contributed to credit growth since the GFC. Finally, also, our model, the way it plays out, does start signaling reserve shortages from early 2019, which is also in line with the repo market disruptions we saw in September 2019. So I'll give you a brief overview of what I'm going to present. Typically, I would give an overview of sort of Fed policy and reserve dynamics over the 10 years we study, but I think for this audience, that's unnecessary. So I'm going to go straight into an overview of our model. We then run some kind of stylized simulations of this model so you can get an idea of the kind of dynamics it produces. We then calibrate the model to the US, and we see what kind of, if we can replicate US monetary aggregate dynamics. Then at the end, we add capital into our model to understand the effect of that change, and we repeat the calibration. So our model is, as I will say again, quite simple. You'll find in my slides are a bit detailed. You don't need to read everything on the slides. I'm going to go through them at quite a high level. So we have a micro-simulation model. Our banking system consists of N, we usually use 100, ex-ante identical banks. Each bank on their balance sheet on the asset side has reserves and illiquid assets. These can be loans or bonds. We are kind of intentionally don't really mind which. And the bank on the liability side funds themselves through deposits. banks earn a positive return on their illiquid assets and a return of 0 on reserves. They maximize profits. So essentially the way this plays out, it's a very simple profit maximization, whereby they're trying to maximize the illiquid assets they hold, but it's subject to a liquidity constraint, such that reserves always have to be greater than 1 minus beta times their deposits. So in a traditional framework, this beta would be the reserve requirement. However, as I've mentioned, we're a bit more flexible with beta. We sort of interpret beta as also maybe taking into account banks, risk aversion or their need to hold reserves to fulfill an LCR or a number of other factors. But beta throughout then is going to be our key variable of interest, and we can vary beta and see how this changes the aggregate beta at the bank level and see how this changes aggregate dynamics. We also have a central bank in our model. The central bank can expand or contract the monetary base by buying or selling assets, so essentially by doing QE. When they expand the monetary base by buying assets, they create new reserves and they also create new currency in circulation. Those reserves all exist on the balance sheet of banks. The currency in circulation exists outside of the banking system. There are 2 other additional smaller changes that we do make to the traditional model, which we think makes our setup much more realistic. First, we did see throughout enacted QE programs in both the US, in the Euro area and in the UK, that a lot of the purchases by central banks are actually the central bank buying an asset from outside the banking system. So let's say an investment fund. The way this works in practice is that the central bank buys an asset from, let's say, the fund. They give reserves to a bank because only banks can hold reserves. And the bank then gives deposits to that investment fund. We model this in our model. So essentially in each period, share Q of assets from the QE program are bought from non-banks. This means the banking system loses 1 minus Q of its own assets, but also produces Q by the new reserves times deposits. I'll show you that on a little T account in a minute. We also, to sort of create a little bit of noise in the reserve series, we allow banks' exposure to the central bank to be heterogeneous, or banks' exposure to this policy. So only some parts of the banking system ever act as central bank counterparties, and the number of banks the central bank interacts with each quarter, each period varies. So it produces a little bit of sort of noise in the series, which has also been documented in the literature. So in each period within our model, there are 4 steps, which I'm going to quickly run you through with sort of explanatory T accounts. So the first step of each period, the central bank, and these steps, which is important, these steps happen one after another. So first what happens is the central bank carries out their QE purchases. They expand the monetary base. Not all banks receive reserves, some do. So if we assume Bank 1 is a bank that receives reserves, their reserves will increase by their share of the aggregate reserve increase. They sell some of their own assets to the central bank. They also accept a lot of deposits. They create a lot of deposits because of non-banks selling to the central bank. In the next period, repayments are made on illiquid assets that are held by banks. Essentially, this works as Y% each period of the illiquid assets are repaid. So illiquid assets reduced by this amount. The repayments are made by deposits from other banks, and that payment is settled by reserves. This, of course, will happen across all banks. So the effect really of this step is that there's movement of reserves around the system, but the important part is that each period deposits will naturally decrease unless banks intervene and create new loans and create new deposits. The third step, which is the most important step in the model, banks then optimize their asset portfolio, which essentially they do by getting all unwanted reserves off of their balance sheet. They do this by creating loans or buying assets. So we can see here Bank 1 pushes down its reserve balances to the liquidity constraint and does this by, let's say, creating a loan. However, we know the reserves exist in a closed loop because central bank reserves can only be held by banks that have deposit accounts with the central bank. So when Bank 1 gets rid of these reserves, by construction, they have to land on the balance sheet of another bank who also has a deposit facility account. So in step 4, that is Bank 2. So effectively what happens is Bank 1 gets rid of its reserves by creating a loan. Whoever draws down that loan then buys something from someone who has a deposit account in Bank 2. So that loan ends up as deposits with Bank 2, and the loan is settled, and this payment is settled using reserves. So while Bank 1 has managed to get rid of all of its reserves that it doesn't want, these have just landed on the balance sheet of Bank 2. And of course, Bank 2 has also done exactly the same thing. So essentially at the end of each period, we get all of the banks pushing reserves off their balance sheets. They're then randomly reallocated across the banking system, and they re-land on other banks' balance sheets. So even though each bank uses up all its unwanted reserves each period, it then almost immediately finds itself holding more unwanted reserves, as long as the system as a whole is in reserve surplus. At the end of step 4, the period ends. We can calculate monetary aggregates by summing deposits, reserves, and currencies across banks and creating this ratio. And then, of course, the process repeats. So we start a new period, the central bank intervenes in the market, increases the monetary base, and it repeats for as many times as we want it to. So to compare this with the traditional money multiplier model, first, in the traditional money multiplier model, this whole process whereby banks use up unwanted reserves by creating new deposits is sort of implicitly assumed to be completed in a single period, or at least before the central bank intervenes in the market again. And this is what creates the stable money multiplier, where essentially the money multiplier will always be this 1/1 minus beta. It's also typically assumed that beta is the reserve requirement, so banks don't want to hold any reserves in excess of the requirement. In our model, as you've seen, this money multiplication process will occur alongside central bank activity. So only one round of that multiplication process will happen before the central bank intervenes again. The other key difference is that we allow beta to exceed the reserve requirement. Other small differences, of course, are that because we introduce loan repayments, banks don't stop creating deposits once they reach their desired level of reserves. Essentially, our system reaches equilibrium, or we define equilibrium as the point where monetary aggregates remain stable. And so actually the system reaches equilibrium when the deposits from loan repayments by borrowers are equal to the deposit creation through the use of unwanted reserves. So actually the system keeps lending and keeps doing things once it reaches equilibrium. And then some other small changes is that we base our multiplication on reserve money, on reserves, not on base money. So, banks aren't consistently relending, dollar bills. We integrate these purchases outside the banking system, and we have some, micro level frictions around market structure. So I'm going to run you through two stylized simulations to give you an idea at a very simple level of how the model then works. So what we do, just to get a really simple idea of what's going on here, is we set up our model with a beta of 0.99, which should reflect a 1% reserve requirement, aggregate deposits of 100, and then we set everything else so the model begins in equilibrium. We keep that beta constant, so we have no change in bank behavior. And then we get the central bank to intervene a few periods in with one huge asset purchase of 10 units. And what we can see here from our money multiplier dynamics is that even with no change in bank behavior, we do get a very sharp drop in the money multiplier. This is essentially because in one period, the banks aren't able to create enough deposits to use up the entire system's unwanted reserves. So because that process just takes time, the money multiplier's recovery is quite gradual. And actually in this setup, it takes about 125 periods for the whole system to get back to equilibrium. And that return to equilibrium happens because when we have that QE intervention, the red line here shows new deposits created by the banking system each period and the repayment of loans. So essentially what happens is that when the central bank, buys a load of assets, creates loads of reserves, banks respond by creating a huge number of deposits and then continuing to do so for a period of time. And the system returns to equilibrium once the new deposits created by unwanted reserves equal loan repayments each period or month. So this is what happens if we have one period of QE, one sharp intervention. If we have an ongoing QE program, we get also very interesting dynamics. We still see this sharp drop, but actually the multiplier keeps falling even as the central bank buys new assets, even though banks are continuing to create new deposits. So if we compare this to what we saw in the, in the real world, or in, let's say, the US, because that's what our calibration example will be, we could say that maybe the drop in money multipliers after the introduction of QE doesn't invalidate the money multiplier model. Maybe this reserve absorption just takes time, particularly when the market interventions by the central bank are so big. But also you could say, okay, but the size and the persistence of that drop, we don't, that's also important to understand. And maybe the size and persistence of the drop does reflect changing bank behavior, that the behavior of banks towards reserves has changed. And maybe, yes, maybe now banks are, passively absorbing reserves, whereas before QE, they actively manage them. So to answer that question, what we want to do then is we calibrate our model to the US. We do this by first calibrating our starting values of our bank balance sheets to monetary aggregate data. And we then get the central bank to intervene each month, the same way that the Federal Reserve intervened in the market. So we match deposits to M2, we correct it for the retail MMFs because that's outside the banking system. We match reserves to aggregate reserves, all of these. We start our simulation August 2008, and we set the repayment rate on illiquid assets to 1%. This is an approximation based on the composition of US bank credit. We then get the central bank to make changes to the monetary base each month in line with observed changes in the monetary base in the US between 2008 and 2019. The ratio between currency and reserves is a whole issue in the model, which I won't cover today, but we sort of remove that issue from the model by just keeping this constant. We're keeping this, in line with what we observed in the US. So essentially changes in reserves in the banking system each month in our model will be the same as changes in reserves in the US banking system. And then changes in aggregate currency, which is in the end in the money multiplier ratio, are also the same as the US. Other micro parameters around sort of market structure, the role of non-banks. We say that 90% of purchases are from non-banks. So most of this QE program is happening with non-bank participants. We base this on Carpenter et al. We let most of the banking system interact directly with the Federal Reserve, but in each period, only 60% of banks do interact. We base those parameters on papers and on the way the banking system works. We also vary them and find that they have pretty limited impact on final results. So our first exercise we do with this calibration is we set up our bank balance sheets. We then get the central bank to create new reserves the same way it did in the US. And we do this with a beta in our model of 0.99. So this beta of 0.99 should produce similar dynamics to the ones you would see with a 1% reserve requirement. What's interesting here is, so the red line is US dynamics, the blue is our model dynamics. With this, we can actually recreate 2/3 of the initial drop that occurred in the money multiplier following the introduction of QE. So this suggests that just because it takes time for banks to use up reserves, we should expect a drop in the money multiplier following a QE program's introduction. Because we are, again, sort of approximating pre-QE behavior of the banking system here. However, in our model, the money multiplier kind of goes back up to where it was, recovers very quickly, whereas we know in the US, we kept this persistently lower money multiplier. What we do next then is that we rerun our model with a range of different beta values to see what kind of reserve demand would produce dynamics similar to those seen in the US. In this chart here, the black line is actual US dynamics. And these reflect the money, and then the colorful ones are our model output with different beta values. And we find that actually our model does a pretty good job of replicating real world dynamics with a beta of between 0.75 and 0.85, which would suggest that banks' desire to hold reserves increased quite a lot following the introduction of QE or following the global financial crisis. And the banks were aiming to hold reserves of about 15 to 25% of deposits. And while this is a huge increase, it's also not the same as passive absorption. Banks in our model with this calibration are still actively using up unwanted reserves. However, when we use these calibrations, that is the money multiplier dynamic versus reality. This is deposit dynamics versus reality. And the black line there is US deposit dynamics. So our model isn't doing a very good job of replicating deposit dynamics. But we think this is because our model is very responsive to new creation of reserves. whereas in reality, we know that banks smooth loan provision over time in response to credit demand and particularly maybe capital requirements. So our next step is to add capital to our model. I'll go through this quickly because I think I'm a bit short on time now. Essentially, we add a new constraint into our model where we add capital onto the liability side of the balance sheet. So on the asset side, we have assets, reserves, and then on the liability, deposits and capital. And we add a capital constraint such that on the ratio between liquid assets and capital. So this includes a simple risk rate where the risk rate on reserves is 0 and the risk rate on liquid assets is 1. Banks can build their capital over time by holding onto their retained earnings. And essentially, so banks can have liquid assets such that the capital ratio is reached. If they reach the capital ratio and they're stuck with it, they can increase their capital base slowly over time by holding onto retained earnings. So in this sense, maybe they're maximizing ROE now. To understand the impact this additional constraint has on our model, we can run multiple rounds of QE, as was done in the US. The blue line here is what the output is without a capital constraint, and the red line here is what you get with a capital constraint. Essentially, banks get all these new reserves, they go to create new loans, but once they hit that reserve requirement, that capital requirement, they have to hold some of those reserves on their balance sheet, and they gradually use them up over time. So you can see here, this is again deposit and loan creation with no capital requirement. You get a burst of deposit creation with each QE program. With the capital constraint, it is smoothed out over time. We then apply this to our US calibration here. So we use two simple capital constraints, 6% and 12%. These are the CET1 ratios we observe in US bank holding companies at the start and the end of the examined period. And again, like with our liquidity constraint, we aren't seeing our capital constraint as the legal requirement. We allow for banks to also have risk aversion, want to have voluntary capital buffers. So we're not interpreting our capital requirement, our capital constraint, as specifically the legal requirement. We find then with each of these constraints, the 12% is the red line, blue is 6%, we can actually do an even better job of replicating money multiplier dynamics. For the first part of our examined period, the tighter constraint does a better job. The looser constraint does a better job. And as I guessed, Basel III was introduced and capital requirements increase in reality, the tighter capital constraint does a better job of explaining aggregate money multiplier dynamics. The same holds for deposits, and you can see here the huge improvement in our model's capacity to explain the real world by comparing that green line is dynamics for deposits without a capital constraint, and the red line are dynamics with this 12% capital constraint. A final thing to note is that our model then does start to signal reserve shortages near the end of the period. Our model signals this by the banking system starting to contract deposits. We know that didn't happen, but we do know that in September 2019, the banking system did suddenly start to act like it was short on reserves, even when it had reserves in excess of legal requirements. So before I wrap up, we do make one final point. I guess you could look at this and say, okay, well done, that's great. But maybe your capital ratio, maybe that's driving all of your output here. And the paper is supposed to be about banks' use of reserves, not capital. So to check that, what we did was we reran our model with this 12% capital constraint with our beta of 0.85, which is what you saw on the last slide, but again then with a really low beta of 0.2. So this could be seen as, this is what happens when the banking system just absorbs reserves. And actually in this case, with the very low beta or very high reserve demand, the money multiplier just collapses and stays low, and it doesn't reflect real dynamics. Also, deposits just contract continuously. So we can see here that banks' use of reserves is playing a role in driving multiplier dynamics and deposit dynamics. So to conclude, we think that understanding how banks respond to reserve creation is really important for understanding and implementing monetary policy. This holds for understanding unconventional monetary policy because reserve expansion might contribute to the transmission of QE, but also to the implementation of conventional monetary policy because we need to understand reserve demand to implement conventional monetary policy in a stable way. Of course, the traditional model for looking at reserve use and the effective reserve expansion is the traditional money multiplier model. It has some very obvious flaws, but we've found that actually with a few minor changes, it can actually give quite interesting insight into bank behavior. And to recap, those three main changes we make are that we allow the bank response to QE, or the bank use of reserves, to take time and therefore to happen alongside a QE program. And this recreates that abrupt drop in multipliers that you see with the introduction of a QE program. We allow reserve demand to exceed reserve requirements. And actually, I mean, again,
Ellen, please go ahead. It's your turn. We lost you for a couple of minutes.
Okay.
So maybe we can, you have 1 more minute, please, and then we can start with Jean's discussion.
Okay,
maybe.
Where did you lose me? I was scared for a second there. I'd given my entire presentation just to my laptop without any connection.
No, it was 2 minutes. We lost the last 2 minutes.
Amazing. So I guess I was concluding. Okay, great. Thank God. I was concluding anyway. So yes, we make these 3 changes to the traditional money multiplier model. And we find what's interesting, I think, really is that we find that we can recreate actual monetary aggregate dynamics. So I think what's interesting here is that it shows that, a simulation whereby banks are actively using up their reserve balances and actively responding to this reserve creation is actually consistent with the multiplier dynamics that we have seen, and that typically you would look at and conclude that this means that banks are ignoring their reserve balances. And we've also in the process created quite a simple, robust model, which I think actually opens up, I think it could be an interesting module just in a wider model. I think it opens up a huge number of further possibilities for other work looking at this topic. It's a bank level model. We create aggregate dynamics from a bank level panel. So we could look at, differences in different demand across the banking system. Another interesting further piece of work would be to look at drivers.
Thank you very much. I think in the interest of time, we should proceed with the last presentation. So hopefully there's some light outside. Sorry, I'm not in my normal office, I'm at home. So I will share my screen in a second. And our last, I don't see, can you see my screen?
Yes.
Yes, so I don't see my screen, so yeah, okay, very good. So the last presentation is about optimal bank behavior under unconventional monetary policy. And I will just get into it as quick as possible. First of all, we have like chapters, introduction, theory, data, econometric approach. We have results and some summary and conclusion. So our motivational or our background. So we see that there was a long time of low inflation, and the central bank, for example, the ECB, tried to cut rates. They tried to cut rates as until they are negative. And sorry, there's some message on the screen. My video is off. I don't know why.
Can you make it full screen?
Yes, I can make it full screen. Sorry.
No problem.
Yeah, so it's full screen, but then I don't see my slides because sometimes, yeah, for some reason, can you see my full screen? For some reason, I cannot see my full screen. I don't know why. I only see parts of it. Anyways, so fine. I hope you can see all the full screen. So this is the problem with this full screen. For some reason, it's bigger than the screen. So maybe I make it a little bit bigger, and then you see my screen. So hopefully, okay.
Yeah,
I'm sorry. That's for some reason I don't know why our screen is not. That's fine. So yeah, I thought there was a long period of low inflation, and so the ECB designed measures to mitigate these adverse effects. And so, for example, sorry, I'm not on this slide. And so the ECB took measures which can be considered as unconventional. And we see that negative interest rates, there are many papers that look at partial effects of negative interest rates on banks' profitability. And it could be negatively affected, especially if deposits are somehow, or some deposits are somehow floored at zero. So for example, in the simple idea is, let's say the lending rate is co-integrated with the Euribor, maybe Euribor plus some spread. And the deposits are, if they cannot move together with the Euribor into negative territory, then your spread interest margin will be negatively affected. And well, for some low deposits, there are negative rates. Actually, for non-financial corporate deposits, there are already some negative rates in the euro area. But for usually for household deposits, it's not allowed, such negative rates are not allowed in some countries, for example, in Austria, or even forbidden by law. And therefore, yeah, this could cut profitability of banks, especially if they rely on loan portfolios or interest income. And well, because of these low margins, there are no profits or less profits, and less profits hinders the capital accumulation of banks' equity. And we know that like the risk-weighted asset channel, so if you have less equity, you cannot grant as much loans as you want because you are somehow constrained by the regulatory requirements on capital. So this is just in a simple model. And this could reduce lending, depends on the capitalization of the bank. Further motivation is, the ECB has designed measures to mitigate these negative effects. And one of them is, for example, the TLTROs. I think we're now in the TLTRO 3. And each of these TLTROs has favorable pricing conditions for banks if they meet certain lending growth objectives. So these TLTRO rates are determined ex post. And so, yeah, it's not so easy to include them in the model because the rates are ex post determined. And therefore, they are quite favorable. And these, I think at the moment, it's -1%. So you even get paid if you meet the lending requirements. And it also goes back to David's presentation today in our session, where they talk about optimal funding designs for lending program. And yeah, of course, unconventional monetary policy could have different effects on lending and profitability, and it is not straightforward to model them focusing only on one category, for example. And there are many papers which looks at negative interest rates, the large asset purchase programs, targeted lending or forward guidance, and they look on different variables as well, lending rates, most likely also lending volumes, profitability and capitalization. But we found that each of these papers has different results, but none of them, also, if you want to summarize these results, they're not conclusive. So we took a little bit a different approach, and I will just skip this last this slide. So we took a little bit different approach and look at the bank optimization model and say, well, banks want to optimize the balance sheet or some items of the balance sheet. Of course, we cannot include all balance sheet items, but as many as possible, and they want to maximize their profits, and there are some form of adjustment costs. So these adjustment costs, they go back in the 60s and 70s of the last century, and they are used in investment decisions, capital accumulation decisions. So it's not, there are some costs involved if you make an investment, sunk costs, contractual costs, whatever. So you cannot just invest, increase your capital stock without any side costs. That's the basic idea, and it was not developed in the context of banks or firms, but it was created in the context of investment decisions. And we also argue that deposit and lending decision depend on each simultaneously. So unless there are certain very unlikely conditions in theoretical models which can show that lending and deposit decisions are independent of each other, because like in the balance sheet constraint that assets have to match liabilities, this constraint has to be met. And so whenever you do more lending, you also need some refunding of this lending. And there are some important works in the 90s and 2000s by Elisiani, Kopetsky, and Van Hoos. And they show that, or they introduced this adjustment cost model for banks, and then they assume that there's something called no portfolio separation or without portfolio separation. And this portfolio separation argument goes around the interbank markets. They show that if you can fund any funding gap based on non-interbank assets and liabilities, if you want to close this gap on the interbank market, and if this can be closed at the same price. So for example, if you pay and get paid the Euribor, for example, on the interbank market, then there would be portfolio separation, because then your lending and deposit decisions of non-bank assets could be independent of each other, because any gap you can just close on the interbank market. But there is some empirical literature based on Elisiani and also others that show that these rates are not the same. And we also have shown for Austria that these rates are not the same, and every bank in Austria pays a different price on the interbank market for assets and liabilities. So what our theoretical model should include, first of all, some kind of optimization. It could also be a bounded rationality model, some time of time dynamics. The balance sheet constraint is important, and some form of adjustment costs, because we do not see banks double in size from one period to the other or completely disappear. Sometimes they disappear, but usually then it's more like some fraud or something that banks have to be closed. But most of the time, banks just evolve over time, grow or decline. And yeah, we extend basically the model of Elisiani. We assume no portfolio separation, and we add more loan and asset, more liability and asset categories. So just to make sure, we have this intertemporal optimization problem where banks try to maximize profits from loans or revenues from loans. So this is the loan rate, category C, and the loans, category C. We include in our model 5 loan categories or asset categories. Then we also include 4 deposit categories. Then we assume that there's also the interbank market, which is the net interbank market position. And then we also include central bank assets and central bank liabilities. So central bank assets would be, for example, the reserve requirements, and central bank liabilities are these TLTROs or other tenders before the TLTROs were introduced before 2014, I guess. And then there's some form of adjustment costs. So basically, if you want to change your loan position from one period to the other, you have to pay a small amount or a bigger amount, and we assume like Elisiani quadratic adjustment costs, but well, there are other forms of adjustment costs that could be used. So DR are the deposit rates for category D, F is the net interbank market. So we include the interbank market because in our data set, we do observe the interbank market positions, but we do not observe prices for the interbank market. And then, yeah, the central bank is the deposits, the tender volumes of the central bank. So this is some kind of the model. And how to solve this model? We take it into the Bellman principle. We have this infinite horizon profit maximization model subject to the balance sheet constraint of the bank. So whenever you increase loans, you also have to increase deposits in the next period so that it matches again. And well, you can also, we did not include capital positions, but in the model, we also have a capital, or at least something which could be proxy the capital position. It's not exactly regulatory capital in our data set, but it's reserve and requirements, which is very close to balance sheet equity. And solving equation 2, we rely on this Bellman principle, so we can basically reduce this model to a 2-period model and assume that banks behave optimally before that and after that. And we can derive a couple of first-order conditions. For the sake of time, we did not report these first-order conditions here, but for each asset category and loan and liability category, we have our own equation, and this depends based on the model on its own leg and the leg, it's leg -1 and leg -2, so the first and second legged volumes, and also the other volumes of the other positions legged by 1 and 2 periods. So this is kind of the idea in the model, and mathematically this would be a system of second-order stochastic difference equations, which can be solved basically by backward induction or forward induction, and you need some conditions that you can solve it, stability conditions mainly, and then you also need some transversality conditions, and such that the construction mapping theorem, which is behind that Bellman principle, can be applied. Okay, so just a few words. I mentioned the interbank market. We found 3 papers that show that, so like Elisian in their first paper, also Dia and et al. They also show that for the Italian and the Scottish interbank markets, there is the banks do not pay the same rate on the interbank markets on the liability and deposit, liability and asset side. And also we found that for Austria, there might be some banking systems where it's the case, but in these 3 banking markets, it was not the case. So that's why we assume no portfolio separation. Maybe a word on lending and deposit rates. They're also expected, obviously, to influence the volumes, and we also account for that in the model. Adjustment costs, maybe final word. There's a long debate. I only mentioned one paper here that discussed the form of adjustment costs. The form is going to influence our structural parameters. That's of course the true, but because we estimate the reduced form, where we afterwards have to identify the structural parameters based on the reduced form, we only, let's say, our model does not depend which form of adjustment costs we have. It just shows our model that there are adjustment costs, and maybe we have not yet identified the perfect structural form, but there's a lot of evidence that there's some adjustment costs. So we have a couple of minutes left. So what are our data sources? We have bank level data, a panel data set from the ECB. Basically, all Euro area countries report monthly data on the balance sheet positions of their largest banks. So in total, we had around 300 credit institutions. Now this set has been extended to all Euro area banks that have a banking license. So they are now around 3,000, but they only report 2 years back. So for the 300, we have data since 2007. We have these individual balance sheet items. They are the individual assets and liability positions, and it's each end of month outstanding amounts. And on top of that, for some of these positions, we also have interest rates on the outstanding amount, and there are also data on the new businesses' interest rates, which we do not use in our setting here. And then, of course, we have some interest rates, market interest rates. So our set of dependent variables are deposit households, deposit NFCs, non-financial corporates, liability securities, central bank liabilities, which are the TLTROs. Then we have NFC loans, household mortgage loans, household consumption loans, asset securities, which, for example, government bonds. And then we also have the central bank assets. We take the log of these volumes because of numerical reasons, because if there's some large banks, small banks, and we also include interest rates as predetermined or strict exogenous variables, we test for that. We would have such, let's say, it's difficult to invert this matrix if you have large values and small values. So therefore, we take the log to make all the values a little bit smaller, especially volumes. But of course, we could also divide by 1 billion, for example, to get these values at a better amount. Of course, we also include some exogenous variables like the Euribor. We also have a dummy for negative Euribor, and we have these QE programs, which we include, such that at the moment only with dummies. We could in the future, we will in the future include these as millions per country, because we have this data, and so then we can look if there are different effects in different countries. So here's such maybe a nice representation of the shares of the asset and deposit side of our 9 categories. Sorry, we just finished the graph today, and maybe you cannot read all of them, but for example, this is the involvement from 2007, around 2007 to 2020, March 2020, and then we also include in the dotted line the last year. So the dotted line represents the last year until March 2021, and this would be the share of household deposits, and it would be around, for the mean large European bank would be around 33%. Then we have share of mortgage loans, which is around 23. Then we have the share of NFC loans, which is declining. Then we have the share of asset securities, which is also a little bit declining. Then, of course, due to the large QE program, we have now an increase in the share of central bank assets, the share of NFC deposits, and the share of liability securities are a little bit declining, NFC deposits a little bit increasing. And then, of course, also the share of central bank liabilities, which are the TLTROs. There was a large increase in 2020 March because of COVID outbreak. There was a lot large tenders were granted by the ECB, and many European large banks and also other banks participated. And of course, you can also see these large asset purchasing programs and the TLTROs also on the opposite side of the ECB balance sheet. Here we have our predetermined variables, which is the leverage ratio. It's capital and reserves divided by total assets. Then we have these loan rates on consumption loans, amount outstanding, mortgage loan rates, amount outstanding, also the loan rate for NFC loans. And then we have the deposit rate for households and also the deposit rate for NFCs. And you see that the NFC deposit rates for the mean bank is still positive, but it's a little bit below the household deposit rate. How to estimate this model? So basically we use a panel vector autoregression model with 3 types of variables, like endogenous variables, predetermined variables, which are somehow treated like endogenous variables, but without their without an own equation. So basically we use past values to instrument the current value, and then we have strictly exogenous variables which are not instrumented. The assumptions, we will skip that. So here we have the results shown as a graph. So you see all the blue dots reflect significant coefficients and at the 99% level, and the gray dots represent insignificant values. So what are the main takeaways from that? I will leave you the graph and read through the results a little bit. So I will show you the graph and at the same time we'll discuss the results. So our first set of results is based on the graph I showed you earlier. So we have also there's a reduction in the share of lending to NFCs. The share of NFC deposit has increased. It's one set of results. So you see that NFC loans are less important. Also, they are mainly those loans which were targeted by the TLTROs. Then the shares of loans and deposits to household have steadily increased. More importantly, while the share of excess liquidity held at the ECB has increased significantly, the share of liability securities has steadily declined. So these liability securities are some covered bond issued by the bank. So basically what they exchange these more expensive covered bonds, they exchange them by ECB TLTROs. So they optimize their funding mix, refinancing mix. And we also see an increase in asset securities, or we do not see an increase in asset securities. So no more government bonds, at least until 2024. Our PY estimation results first show that the adjustment costs are important. So the legs in each equation, so this is equation 1, equation 2, equation 3, in each column you have the equation, and in the rows you have the independent variables, the legs of all the other dependent variables until leg 2, and then you have also the loan rates here at the bottom, and finally our set of dummy variables, which are also here. And we find, first of all, as you see, that most of the significant results are the leg of the dependent variable in each equation. And this means there is some form of adjustment, meaning that a bank slowly adjusts its volumes, but cannot fully remove all household deposits because the TLTROs are cheaper. So you can get rid of all household deposits and only subsidize them with TLTROs. So you cannot do that from 1 month to the other. So these are monthly rates. So these adjustments are based on a monthly basis, and therefore you cannot completely change your funding or your asset side. So yeah, adjustments are important. Then we find a reduction in liability securities caused by an increase in central bank liabilities. So banks, and there are also reports on many web pages where banks were asked what are the main objectives when they enter the TLTRO, and the main objective was profit maximization. So they knew that these central bank liabilities are cheaper than, for example, asset securities, liability securities, and therefore they did not roll over these liability securities, but exchange them for central bank liabilities. And of course, they keep in mind that they have to meet these certain loan growth requirements. These loan growth requirements is for NFC loans and for consumption loans to households. They do not include mortgage loans. So basically, mortgage loans are not part of these favorable terms. So you don't have to meet any mortgage loans. So I'm a little bit low on time. So I will go through. We went through this. We also went through this. And we also see that lending for household purchases and consumption are mainly driven by other variables, but not by the Eurosystem financing. And in case of lending for consumption, this effect is even negative. And we also see a stronger household mortgage lending, and this is also based on all sources of funding. And it seems that mortgage lending to households is still profitable. And one reason could be that you do not have high capital requirements for these mortgage loans because usually they are collateralized. And of course, there's also a strong demand because of house prices are increasing. We do not see many effects from the asset purchases programs, except that they, of course, increase the assets at the central bank. And for the lending rates, we see that there's some cross-price elasticity. So if a lending rate in one loan category increases, then it reduces the lending in another category because banks try to find those loans which still offer the highest rates. Of course, finally, our conclusions. So lower, even negative interest rates raise concern about the possibility of impairment of transition mechanism having negative effects on financial stability. And the OENB contain elements which were designed to protect banks' profitability. And we see that partly in our results. And we also add that the banks maximize the portfolio, so the balance sheet structure, and it is subject to adjustment costs. And we see that clearly in our model because there are some the legs of the dependent variables are highly significant in each equation. And our dynamic optimization model, which is based on existing models from the banking literature, but also from these models are very popular in the 80s. Sarge and Blanchard, they used it many times for more macroeconomic models. And of course, yeah, adjustment costs are very significant. And yeah, I'm sorry, I'm running out of time. So I would say thank you for your for following our presentation. Also, thank you for attending our presentation. And I would like to give the floor to Romina with her discussion of our results. So can I stop sharing somehow? Yes, I have to click something here, right? Abbrechen. Yes. Yes, thank you very much. And Romina, the floor is yours. Sorry for a little bit over time, but I think we have a couple of minutes left. I'm very looking much forward to your comments.
Thank you very much. So I hope you can see the slides moving.
Yes, we can see it and we can hear you.
Great. Thank you very much for asking me to discuss this paper. I think it's very interesting. So I have a few comments. I'm just going to go through the presentation quickly. So before I go to the comments, I want to briefly summarize what the paper does and kind of the research question and the results. So kind of the main research question in this paper is that to see if unconventional monetary policy measures are actually effective in increasing bank lending. And there is kind of a large existing literature that discusses this question. And as you mentioned in your presentation, the results are actually can be quite different. So if you look, for example, at the negative interest rate literature, there are some papers that find that negative interest rates actually do increase bank lending, whereas other papers actually find the opposite. So in this paper is kind of a contribution to this existing debate. The paper consists basically of two parts. So first of all, the authors build a partial equilibrium model where banks have costs when they want to adjust their assets or their liabilities. They can lend out, so they can make loans, they can accept deposits and borrow in the interbank market, and they have access to these TLTRO measures. So I think this discussion is really based on the kind of the old version of the paper. So I think what you presented today, the banks can also access the deposit facility, for example, at the central bank, which I did not write down here, but yeah. And the second part of the paper is that this model is then used to estimate the effects of unconventional monetary policy measures. And the authors do that using a fixed effects panel vector or the regression model. And they use data from 323 banks from the time frame between 2007 and 2019 in the euro area. So let me briefly summarize the results. So again, here I kind of focus on the results that are discussed in the paper. So first of all, the authors find evidence that there should be no separation. So lending and refinancing decisions actually should not be modeled separately when you look at banks. Then they find that if the spread between the deposit rate and the Euribor rate is increasing, this actually leads to an increase in bank lending. And this effect is actually even stronger when the policy rate is negative. And they also find that TLTROs had a positive effect on bank lending. And in general, unconventional monetary policy lead to an increase in bank lending, but they do not see the same effect in deposits. Okay, yeah, so I'm gonna make a few comments now. So first of all, I would like to address this adjustment cost channel. So I think one of the key mechanisms of this model is really that banks face this adjustment costs when they want to adjust their balance sheet items. And if you look at the existing literature, so for example, in the negative interest rate literature, I'm not aware that any theoretical paper actually addresses this adjustment cost. So I think this is kind of this paper emphasizes an additional channel in the literature that has not really had a lot of attention. So regarding to this adjustment cost, I think it would be interesting to see if you have these adjustment costs, how exactly does having these adjustment costs in the model is going to improve the theoretical predictions, or how it's going to improve the empirical results. So I think you already mentioned this in the presentation, that you actually do find evidence for this adjustment cost. This is something that wasn't really emphasized in the early version of the paper. So I think another thing I think to think about would be to look at retail deposit rates. So if you look at the negative interest rate literature, there are several papers that find that banks actually do not pass on the negative interest rate to retail depositors. So this may be, in some cases, this is a legal constraint. In other cases, they choose simply not to have negative interest rates for their retail customers. And other papers that look at balance sheets during near periods, actually, or negative interest rate periods, actually find that these retail deposits did not change much. So, and from a purely theoretical perspective, you would expect banks to kind of get rid of these very expensive retail deposits, but this does not seem to happen. And I think this bank balance sheet adjustment cost could provide a potential explanation of why this is happening. So this might be something that could help motivate this balance sheets adjustments in addition to your empirical evidence. Yeah. So regarding the function, so you in the theory part, you assume the specific function for the adjustment cost, and I think you follow here the paper of Eliasiani et al. And you mentioned in the presentation that because you estimate the reduced form, this specific cost function doesn't really matter. But I kind of asked myself, so if you don't need this specific cost function, then why do you need to make that assumption? So is maybe there is some evidence that this cost function is actually very realistic, or is it do you follow the existing literature, or so it would be nice to have some idea of why you make this assumption on the specific function of the cost function in this balance in the balance sheet. Yeah. Then I have an additional comment on bank profitability. So you mentioned this very early in the motivation that, for example, if you have negative interest rate, this might affect bank profitability, and this then might lead to lower capital, which could lead to lower bank lending in the future, or even an increase in financial instability. And in the empirical section, you also look at how if well-capitalized banks behave differently than less well-capitalized banks. But I think in the model, it would be interesting to actually address this channel a bit more explicitly. So within you have this constraint, this balance sheet constraint. And I think the way I understood it is that if bank profits decrease, then this is going to affect equity, and this is going to affect how banks behave in the future. So I think it would be interesting to emphasize this channel a bit more also in the theoretical model, to have this talk about this, how this decreased bank profits might affect bank lending in the future. Yeah, and lastly, also, in the model, from what I understand, banks take lending and deposit rates as given. And there are some papers that show that this might not be true in reality. So for example, if you look at the Ferstl paper, who look at deposit rates in the US, they find that banks actually do have some market power when it comes to deposit rates. And maybe this is also true in the Euro area or for lending rates. And I was wondering then, if banks do have some market power over these lending rates, how is this going to affect the theoretical predictions or even the empirical results? So for example, is it possible that if banks can actually set or increase lending rates as a result, for example, due to low profitability, how is this going to affect then the lending volume? Yeah. Now, before I conclude, I have some minor comments. So again, this refers kind of to the old version of the paper. So in the model, in the old version, they're not all parameters explained. So for example, RO, I think, refers to reserve requirements, but it's not really explained in the paper what exactly that parameter represents. So I think it would be helpful to just write this down. And I think it will also be interesting to relate your results to the existing literature, especially the literature that also finds the opposite effect. So there's, for example, if you look at the negative interest rate literature, there are some papers that actually do find that negative interest rates decrease bank lending. So it would be interesting to see how your model and your approach actually relates to these different results. And lastly, it would be interesting to see how these results vary across countries. So for example, Arseneau et al., they make a point that, so they look at negative interest rates, the effects of negative interest rates in Spain, and they actually make the point that because when the ECB introduced negative interest rates, not all countries were in the same circumstances, and therefore the introduction of negative interest rates or maybe even additional unconventional monetary policy measures such as APP or TLTROs might actually have different effects in different countries. And I think that would also be interesting to look at that in this paper. So to conclude, I think it's a very interesting paper that emphasizes this mechanism of this adjustment costs for banks. That is something that is not really has not really been focused on in the literature. And the topic is, of course, highly relevant for policymakers, and it makes an interesting contribution to the ongoing debate of unconventional monetary policy measures. So, thank you.
Thank you very much, Romina, for this excellent discussion, and we will gladly analyze all your points. There's also a question in the chat, so we have at least would say 5 minutes. I think the next session starts in 11 minutes. So thank you for all of them who stayed here. Maybe I can try to answer the question here in the chat. Yeah, the quadratic adjustment costs also for the outstanding loans is asked by Jean. That's an excellent question. So basically we stick to the literature on this adjustment cost approach, but of course we could assume that there are no costs for existing loans, but maybe you have auditing costs, stuff like that. You have to audit, collect balance sheet items from corporations, look at the customers of the households, if they can really repay, if they're unemployed or whatever. So this could be taken into account, and the adjustment costs could be very small. But whenever there are very small adjustment costs, you can somehow develop this optimization model. There's another question by. Sorry, I cannot read. It's by David. I think it's David. It's a paper that develops in this. That's very nice. Craig Furfan, yeah, I will look at this paper. Sorry, this literature was not part of. Thank you, Diana, for joining our session and for discussing the paper. Thank you. There's this. I did not know this paper, but from Craig, I will write down his name.
Yeah, it's an interesting paper. Michael, I could tell you that, with some colleagues, actually my co-author in the paper that I presented was part of this. We actually tried to replicate some of the results in that paper, and we actually didn't make a whole lot of progress on it. But it's an interesting paper, and given what you're doing, I think it's worth looking at.
Thank you very much. Thank you. Sometimes you overlook literature, so when you don't search correctly. Thank you very much. Are there any other questions for the other papers? We have 9 minutes left, so we can discuss. Maybe there are other questions from the first two papers. maybe I have a question for the first paper. Maybe I did not get everything because I was a little bit nervous for my presentation, but did you try to somehow look at these capital requirements in designing these lending programs, optimal funding for lending? Did you look somehow at capital requirements? Because maybe if a bank has a very high capital ratio, maybe it's less affected by...
Yeah. I mean, it's a good question. The short answer is no, we didn't do that. I think sort of what I view the value added of the paper, that the framework that we presented is just a very simple framework that allows you to develop very tractable analytic expressions that can be easily taken to the data. So, while Michael, I think you're right, thinking about how capital requirements would affect those results. I think it's an interesting question, but it's a little farther than our paper goes.
Thank you. I mean, I just was wondering because it's a very good paper to our paper, because you model basically the funding for lending, and we also try to make sense why funding matters for lending, or could matter for lending at least. Okay.
Yeah, that's right. And I view your paper as, having adjustment costs on the, so I've looked into this before, and I'm a bit surprised that in the dynamic banking literature, you just don't see a lot about portfolio adjustment, the dynamic aspects of portfolio adjustment. It's a bit disappointing, actually, particularly for policy purposes. So your paper tries to get at that. And yeah, I do think it's relevant for funding for lending. We assumed a lot of the interesting parts of portfolio adjustment away through simplifying assumptions in the interest of analytic tractability, but there's no doubt that they're important. And I think your empirical framework sort of goes down that route. So I think it's an important area to better understand. Particularly for the CCYB, how banks react to the countercyclical capital buffer. I think the dynamic portfolio adjustment of that question is extremely important, and we don't know much about it.
That's true, yeah. Because, for example, in Switzerland, they have a CCYB for different portfolios. So then what they see, I guess, I saw one paper, they saw that if there was a CCYB for, let's say, mortgage loans, and so the banks increased the lending in other areas. So some kind of rebalancing their portfolio and keep the same lending, but not in the same sector. So this.
Yeah. I mean, at the end of the day, it's a little bit crazy, right? I mean, it has to be, whether you want to, general equilibrium is not it has to be an equilibrium response given the bank's entire portfolio. And to not acknowledge that, I think is just going to lead you down the wrong road.
Yeah, that's of course very true. Okay, so I think we had two very good papers, one okay paper like mine. I would like to thank everybody who was here in this session. I think we ran down a little bit of time, but I guess we had to cut some of the discussants a little bit down to the time. I would also like the discussants I would like to thank the discussants for joining the session and giving us three authors very good feedback and to improve our paper. Yeah, and finally, I wish good luck to everyone in the publishing process or in the process of getting new insights. And I hope that we will meet maybe next year's conference in person, and we can discuss something maybe at the dinner or some nicer venue than sitting in front of our computers. So have a nice evening, or for those of the US, have a nice afternoon. And I wish you all a nice weekend, and hopefully see you in the future. Bye for now.
Thanks. Bye. Have a nice weekend.
Bye, everybody. Have a good weekend.